Welcome to Finance News Frontier's latest explainer. I'm your host and director here at the Frontier. Today, we're looking right past the mainstream software hype to uncover the massive industrial supercycle that's quietly redefining the market. I mean, what we're witnessing in 2026 is a historic reconfiguration of the S&P 500. So forget the code for a second. This is really about concrete, copper, and cooling. Let's dive right into the Great AI Buildout.
Let's kick this off with a massive reality check. While everyone's been fixated on generative software apps over the last couple of years, the world's biggest tech companies quietly pivoted. They realized the true bottleneck wasn't the software at all, it was the hardware. As the saying goes, the $800 billion AI revolution isn't happening on your smartphone. It's happening in the dirt, the power grid, and the physical pipes of the internet.
And here's what most investors are just completely missing right now. There's this massive software-hardware divergence. It's kind of like a total illusion. Traditional legacy software stocks are actually floundering. They're seeing some of their worst performance since the 2008 financial crisis because they're struggling with the astronomical costs of retooling for AI. Meanwhile, the reality? Physical layer infrastructure stocks are literally doubling in value, single-handedly driving the S&P 500 past that 7,000-point threshold. The smart money has officially moved from the folks writing the code to the ones providing the picks and shovels.
To really grasp the sheer gravity of this shift, consider this staggering figure, $725 billion. That's the projected capital expenditure for 2026 alone, and that's from just 4 companies, Alphabet, Amazon, Meta, and Microsoft. They're dedicating their budgets almost entirely to AI servers, massive data centers, and the networking fabrics you need to make it all run. This isn't just a tech upgrade anymore. We're talking about a full-blown industrial build-out.
And that $725 billion number, that represents a massive 77% year-over-year increase from 2025. It absolutely obliterated initial Wall Street expectations. What we're watching is a frantic arms race. Take Meta, for example. Virtually overnight, they pivoted from a capital-light social media advertising machine into one of the world's absolute largest industrial investors. That's exactly how fast the ground is shifting under our feet right now.
Now, when you zoom out and factor in players like Oracle in the sprawling infrastructure supply chain, the scale of this arms race surges to an $800 billion total physical buildout. We are talking about custom silicon programs, advanced memory procurement, and the immense ground-up construction costs of these AI factories. It's literally a tidal wave of capital completely reshaping industrial supply chains across the board.
So why should you care about this? Well, it boils down to one number. 2%. This single technological deployment is so incredibly massive that it's actively consuming nearly 2% of the entire United States gross domestic product. To put that into perspective, that's a reallocation of national resources we usually only see during wartime or historic infrastructure pushes like the interstate highway system. The entire economy's center of gravity is shifting directly toward these physical deployments.
This brings us to our first major section, the hidden bottlenecks, or the plumbing of the digital world.
So where exactly is the smart money flowing? Directly into solving these bottlenecks. You see, the general public is completely missing a massive structural shift happening in memory right now, specifically HBM4, or high bandwidth memory. It is so ridiculously resource-intensive to manufacture, requiring up to 16 vertically stacked dies, that it's displacing massive amounts of conventional memory output. This has turned the traditional boom and bust chip cycle into a permanent structural deficit. Storage and memory stocks are exploding right now simply because they suddenly possess unprecedented pricing power.
Then, there's the surprising thermal reality. The era of traditional air cooling in data centers is officially dead. It's failing outright because it just cannot handle the heat generated by modern 100-kilowatt AI racks. Overnight, liquid cooling transitioned from an optional luxury upgrade to a mandatory standard. Without it, these massive AI factories would quite literally melt down. This sudden pivot has turned niche thermal management companies into the absolute hottest industrial stocks on the market. But perhaps the most alarming hurdle of all is the power grid itself. We call this the time-to-power energy constraint. Between geopolitical tensions, like the recent blockades in the Straits of Hormuz spiking oil prices, and severe regional grid caps, companies are realizing they simply cannot wait for public utilities to catch up. So we're seeing a massive boom in on-site independent power generation. Companies are buying up fuel cells from Bloom Energy and advanced solar setups just to guarantee their data centers can keep the lights on. It's a huge resiliency play in an increasingly fractured world.
Moving on to our next section, concentration risk and the forced institutional chase.
Because of this unrelenting hyperscale spending, we're witnessing a historic and, frankly, kind of terrifying reconfiguration of the broader market. AI-related infrastructure stocks now dominate a breathtaking 45% of the total S&P 500 market cap. This creates a fascinating chain reaction. Because these stocks take up so much of the index, passive index funds and active managers are essentially forced to aggressively chase the trade. If they don't buy these physical layer stocks, they immediately underperform. It is quite literally a forced institutional chase.
The market's reliance on this build-out is just staggering. Right now, 40% of all projected earnings growth for the entire S&P 500 index is riding squarely on the success of these AI physical layer companies. Traditional utility and industrial stocks are being re-rated as high-growth AI infrastructure providers. Just think about what that really means for a second. Our entire stock market's growth is basically resting on the successful execution and profitability of these specific data center buildouts.
Which brings us to the ultimate Wall Street debate right now. Are we looking at a historic, sustainable, secular boom or an AI technical dead bubble? Now, the bulls confidently point out that, unlike the dot-com era, current AI infrastructure is backed by real, urgent enterprise demand and companies generating massive free cash flows. But on the flip side, the bears are warning of a severe demand gap. They see a terrifying discrepancy between the hundreds of billions being spent on hardware and the actual revenue currently being generated by consumer software applications.
And here's the hidden threat that agencies like S&P Global are quietly sounding the alarm on. It's called the efficiency pivot. The industry is currently building these monolithic $100 billion data center clusters. But what if algorithmic breakthroughs or hyper-efficient open-source models from overseas competitors like DeepSeek suddenly make smaller models just as effective? If the software suddenly requires less brute force, well, those massive, incredibly expensive data centers currently under construction could face a sudden and catastrophic devaluation.
So the world is fundamentally transforming its physical landscape to accommodate artificial intelligence. But the ultimate question remains, is this a sustainable secular boom reshaping human industry, or is it a massive AI technical debt bubble just waiting to pop under the weight of its own infrastructure costs? I really want to hear your take on this $800 billion industrial supercycle. Drop into the comments right now and let me know. Are you buying the infrastructure boom, or are you bracing for a bubble burst? Thank you so much for watching this explainer from Finance News Frontier, and I'll see you in the next one.
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.